Let's go to this debate of large cap, small cap, and what looks cheap, what looks expensive, what kind of allocations people could consider there. I'm going to start this off with a slide, and then we're going to go to the conversation. The slide here shows the long-term history of relative value, the forward PE multiple using the two most common standard generic, we call them generic benchmarks, the Russell 2000 PE compared to the S&P 500 PE. And you'll see over that period of time, the average over that long period of time, we'll call it 5 years, is about 1.45 times, meaning the forward PE on the Russell is higher. And of course, that's because, as Kevin's going to say, many of the stocks in the Russell don't make any money. And so the PEs tend to get a little distorted by that. But we'll get to that afterwards. What this shows is today, small caps are cheaper than average by quite a meaningful amount, somewhere near the cheapest relative value versus the S&P 500 that we've seen over the past 5 years. You can look back at that blue line and see maybe once in history was it as cheap or cheaper than today. So that's the backdrop. That's the data. All right, let's go back to our images here. And Kevin, let's just talk about small cap. What are your thoughts on small cap? How do you allocate?
You know, small cap doesn't necessarily mean value. Small cap traditionally means that you're getting slightly higher growth than the S&P 500. You're hoping you're capturing a company going from small to mid to large cap and enjoying that ride. But that's hard to find because, you know, the whole idea is in managing a portfolio is how much volatility do you want to take on? Now, small cap is generally more volatile than large cap stocks. If you're willing to stomach some of that volatility, you get rewarded with higher growth. And that's always interesting long-term for an investor. So there is a place inside of a portfolio for small cap. Now, how do you find those small caps? When you've got 2,000 companies, of which the majority make no money, it's extremely hard to go balance sheet by balance sheet, income statement by income statement every quarter, trying to mine those and build a portfolio. There are specialists that do biotech, for example, or do real estate or whatever in the small cap. But if you want to have the breadth of an index, you need a rules-based approach. In other words, where you're actually looking at every single income statement and determining over time which ones are meeting your rules and stay within the index. And that's exactly what OUSM does. It's mining for the more stable, profitable small cap companies, and that's the index I use. So you've got a large number of names across multiple sectors, and you have slightly higher growth, hopefully, because that's what you were rewarded with in small companies. So OUSM, for me, that's a 20% weighting. That's how I play small cap.
I'll give people a quick synopsis of the rules. Basically, the stocks that are in OUSM are stocks that score well for profitability, cash flow to debt, dividend coverage, dividend growth. Those are some of the core quality metrics that determine which stocks make it into OUSM. Anyone who'd like some information on OUSM, get it on our website, or please send us a note, info@oshares.com. Let us know if you're an advisor. We're allowed to go even deeper into the portfolio with you. Thanks for the comments on small cap, Kevin.